And lots of info flying at us on Friday. MBS opened up flat, and we're down 25 basis points real fast when the non-farm payrolls crushed expectations. So non-farm payrolls came in showing that we created 339,000 new jobs on 190,000 forecast. It was 253,000 previously. The unemployment rate came in at 3.7% versus a 3.5 forecast. It was 3.4% previously. Participation rate remained unchanged at 62.6. Earnings declined a little bit, came in at 0.3 on a 0.4 forecast, was 0.5 previously. That makes 14 straight months that the payroll gain has beaten the median estimate by Bloomberg surveys, showing that jobs are staying strong, which could give the Fed ammo to justify another 25 basis point rate hike if they see fit. A miss this big should have actually led to a huge sell-off in bonds, but it didn't. Why not? Because it's incongruent with the rest of the data. Unemployment jumped to 3.7 from 3.4. The same participation rate, meaning that it wasn't due to less folks saying they were looking for work, and wages did drop. We saw in the ISM report that supply chain issues are pretty much done and commodity price inflation is largely over. Home prices peaked a year ago, so the component of inflation is about to fade, though rents tend to lag home prices by about 21 months on average. We also got a piece from the St. Louis Fed President James Bullard, who released a piece yesterday that's comparing the current Fed funds rate against the suggested rate using the Taylor rule, which is a widely used model for monetary policy over the past 30 years. According to this model, which gives us a range of rates, the Fed funds rate is back in the range after a long time below it. Monetary policy was too tight in early 2019, and the Fed began easing in late 2019. It was correct afterwards until late 2021 when the Fed got behind the curve. Also got some interesting data about the market that I didn't realize. Did you know that refi loans still account for 26.7% of total applications last week? So there are still refis out there. It's just somebody's out selling it, and some people are just taking orders. The relentless rally in big tech options positioning and bets on the Federal Reserve pause. Following mixed job report, but stocks on the verge of a bull market, a gauge of mega caps like Tesla and Apple headed towards its sixth straight week of gains. The longest winning run in almost 2 years, Broadcom Inc. climbed after predicting that sales tied to artificial intelligence will double this year. As stocks rallied, Wall Street's fear gauge plummeted towards its lowest level since February of 2020, which means money had to come out of bonds. We ended up on the day down 34 basis points. The 10-year was up 10 basis points. Stocks won big with the S&P 500 gaining 61.35 points at 99.83. That puts us right below this 25-day moving average, so the range is narrowing up a little bit with a floor at 99.845. So actually, yeah, I'm mistaken. So we ended up right below that 99.845 Fibonacci retracement line, which is the flat one there, which puts us down in a pretty wide range. So hopefully we can climb back above that so we don't have a big choppy week next week. We also got news that we are currently about 50% of the way through liquidation of Signature Bank and Silicon Valley Bank portfolio liquidations, at least in specified pools, and according to B of A's Bill Beckerly. A resounding success in terms of execution. So they've burned through about half of that, which kind of the fact that we had a pretty winning week with all of that liquidation means some good things. However, many other specified sectors are trading less well. REIT demand generally has been underwhelming as of late, and 200 to 275K balance pools as well as FICO LTV investor have struggled to find footing on the production coupons. Loan balance 6.5% pools remain somewhat of a no man's land, so nobody wants to buy those because they figure they're just going to refi next year. Looking at next week, not a lot of data coming next week. The big one is going to be on Monday when we get the PMI survey. So it's going to be show how much it's costing to make goods, which will ultimately end up in prices. The rest of the week is kind of minor players. We'll probably have some eyes on the jobless claims considering the non-farm payrolls giant beat today. So if you have some time over the weekend, check out our common influences and sources, our sponsor at wellthatmakesense.com, as well as all this other great information. Have a great weekend.